Hello and welcome to this lecture video. This lecture video is going to cover flexible budgets versus static budgets. I am on page 227 of your course pack. Okay? So fixed budgets are also called static budgets, and they're based on a single level of activity. And they can be useful in some contexts for comparing actual to budget. So for example, if we want to say, we want to compare how well we did to how well we think we should have done, which is our budget. And I used to do a lot of this when I worked in industry, is comparing actual revenues and actual expenses to our budgeted revenues and budgeted expenses. The only problem with fixed budgets, though, is that they're based upon a single level of output. So they're really useful if we said, you know what, we planned on making 100,000 bottles of soda, and then we actually made 100,000 bottles of soda. It would be useful in that context. But the problem is, that doesn't always happen. That sometimes unit sales could be more or less than budgeted. So for example, if we made 110,000 bottles of soda, and we were only planning on making 100,000 bottles of soda, we would expect some costs to be naturally higher, some expenses to be naturally higher, simply because we made more bottles of soda, such as our materials costs, our ingredients costs, our labor costs. Basically, we would expect all of our variable costs to be higher if we made more than we thought we were going to make. So there is some limited benefits to our fixed budgets, okay? So if we look over here in terms of the other way we can look at it is called a flexible budget. This would also be called a variable budget, and it shows revenues and expenses that should have occurred at the actual level of activity. So this is a better way of looking at it in a lot of ways, because what we can say is, let's go back to that scenario that I was saying. We made 110,000 bottles of soda. We only thought we were going to make 100,000 bottles of soda. There are some costs, such as ingredients costs and labor costs, that would be naturally higher simply because we made more bottles of soda. All right? That's the problem with the fixed budget. With the idea of a flexible budget, what we're going to do is we're going to redo the budget at 110,000 bottles of soda, or look at the budget for 110,000 bottles of soda, which is how much soda we actually made. And we can compare those two because the volume is the same. We actually made 110,000 bottles of soda. We thought we were going to make 110,000 bottles of soda. Now we can compare our materials costs, our labor costs, our variable overhead, as well as our fixed expenses. And now it makes sense to compare those two because they're on the same level of units, right? So if we look over here, they can reveal, so our flexible budgets can help us to reveal variances that are due to good or poor cost control. And then that helps with our performance evaluation. So now what we can do is we can hold managers accountable for controlling costs, and we can say, well, you can't claim the reason that your costs are higher is because you made more bottles of soda than you thought you would. Can't claim that anymore because now what we've done is we've put the budget on the same level of unit sales as we did what you actually had. So now we can say volume is not a reason for any type of variance. Okay? So we know about fixed cost behavior. We know about variable cost behavior. And let me just kind of talk about these again really fast. I'm not going to complete this here because we should know this by now. But remember, fixed costs stay constant in total. They decrease per unit as activity increases. Variable costs, on the other hand, stay constant per unit, and they increase or decrease in total with the level of activity. So when we look down here with flexible budgets, what we can do is we can express a variable cost as a constant amount per unit. So we can come over here with our sales, and we know our sales price per unit is $10. And what we can do is redo the budget at different levels of production, at different levels of activity, which makes it flexible. So then what we can say is, oh, well, we have a budget at 10,000 units. We have a budget at 12,000 units. We have a budget at 14,000 units. Now what we can do is we can say, well, actuals came in and we actually made 12,000 units. So we can pick this budget that's 12,000 units and compare that against our budget of 12,000 units, right? So let's take a look at how we got each one of these numbers. So we have our sales of $10 a unit times the level of activity. 10 times the 10,000 gives us 100,000. 10 times the 12,000, 120. 10 times the 14, 140. Our variable cost per unit, we know that those stay constant per unit. So what I can do is go 10,000 times $4.80, 48,000. 12,000 times 480, 57.6. 14,000 times my 480, 67.2. Contribution margin we know is sales minus variable expenses. And then that gives us our contribution margin. And we understand total fixed cost behavior. Remember, total fixed costs stay constant in total across all levels of activity within the relevant range. So we see that each one of these is $40,000. And then we can calculate our income from operations by subtracting the fixed costs from the contribution margin to get our income from operations for each level of activity. Okay? So if we look over here, this is what I was talking about earlier, the way we got to calculating those variable costs per unit, just like this, all right? And as I was saying earlier, our fixed costs stay constant. Now we have our flexible budget performance report, okay? So what we can do, this is what I was saying earlier, we have our budget for 12,000 units, and then what we have is we come in, we say we actually did 12,000 units. We pull out the budget that we did for 12,000 units, and look, these two are the same. That's important because if this were 14,000, we would expect that variable costs would be higher because they increase or decrease with the level of activity. Now that these are the same, we can look at our variances and we can then look for the reason why we have these variances, and we know one reason why we don't have these variances is because of volume, because the volume is the same. So these variances are not due to volume. They could be due to something else. So we look at our sales right over here. We have 120,000, 125. How do we get that? We take our sales of 12,000 units, and then times our sales price per unit gives us our 120. This is how much sales we actually had. We have a variance of $5,000, and it's F for favorable. Why favorable? Because sales, actual sales, is higher than budgeted sales. And that's a good thing. Okay? So this is actually how much sales we had. I didn't get this by multiplying the 12,000 times 12,000. Obviously, that's not 125. I got this, 125, just by saying this is how much we actually sold. This is our total sales dollars for the quarter or for the month. That's how much we actually sold. And it's a favorable variance. Then we can look over here at our variable costs. 480 times the 12,000 gives us this. And then these were our actual variable costs. And why is this unfavorable? Because actual costs are higher than budget, which means that would then decrease our profit. And the difference is $1,800, and I put a U there for unfavorable. Contribution margin, sales minus variable expenses gives us our contribution margin. It's $3,200. In this case, it's going to be favorable because actual contribution margin is higher than budgeted contribution margin. Then we looked at our fixed costs. We budgeted for 40,000 fixed costs. We actually had 40,200 fixed costs. It's $200 unfavorable. And then that cascades down to our income from operations, $3,000 favorable. Okay? So again, what I'm saying right over here is the flexible budget performance report helps us compare apples to apples, so to speak. And we put these on the same level of volume, and then we remove volume as a possible explanation for any of these variances. Okay, so our actual and our budgeted units are sold are the same. Okay? So if we look over here And this is one of your problems that you have. So this is a really good problem. It's saying to prepare a flexible budget performance report for the year. Okay? So what I'm going to do is I'm going to come over here, and I think we have an extra page right here. I'm going to do this on another page. Right? So I'm going to come over here. The way I'm going to solve this is I'm going to prepare my income statement. So I have budget, then I have actual, then I have my variance. Right? Like this. So I'm just going to go down like this. I'm going to write sales, and then I'm going to say my variable costs. I'm going to say my direct materials, my direct labor, my variable manufacturing overhead, my variable operating expenses. Then that gives me my contribution margin. My sales minus all my variable expenses would give me my CM, contribution margin. And then I can say fixed costs like this. I have my overhead. Then I have my operating fixed costs. And then what I have is net operating income, income from operations right over here. Now, if we look over here, we can see that we have our fixed budget data for the year. This is my sales. 20,000 units gives me $600,000. How can I figure out what my sales price is? Well, it doesn't tell me, but there's a way I can figure it out. I can take my 600,000 divided by my 20,000, and then that gives me my sales price. Same thing here with my cost of my materials. I could take my 200,000 divided by my 20,000, and then that gives me my direct materials per unit sold. Direct labor, 160 divided by the 20,000, gives me my direct labor per unit sold, so on and so forth here, and then also with my variable operating expenses down here. Okay? Here's the thing. Here's the problem though. Why can't I compare these? See, income from operations is 48,000 here, but that's at 20,000 units. That's what we budgeted for 20,000 units. What we really did was 49,500, okay, which means our income from operations looks more favorable than our budget. But the problem is, look how many units we actually sold. 21,000 units, okay? So I'm going to do a little bit of this for you, and then what I want you to do is stop the lecture video and start on the next lecture video where I finish going over this. Okay, so I'm going to start you off. So what I have over here, what I need, and let me back up, what I need to do is I need to redo this budget. See, this is fixed budget. I need to redo this budget at 21,000 units, because right now it's at 20,000 units. I can't really compare these two numbers, because one's at 20,000 units, one's at 21,000 units. Some of these expenses, I would expect that they should be higher simply because I made more units. Same thing with sales. I sold more than what I thought. Of course my sales number should be higher. But if I redo the budget at 21,000 units, now I can say, you know what? Budgets are at 21,000 units. Sales are also at 21,000 units. And let's now look at income from operations to see really how well did you do. So again, getting back to how can I do that, what I need to do is I need to put my sales on a unit basis, all my variable expenses on a unit basis, and then multiply that times 21,000. Okay? So if I look over here, again, I'm going to start you off, and then I'm going to pause, I'm going to stop the lecture video and go on to a second lecture video where you can log over it in more detail and you can check your work. So if I look over here, the first thing I need to do is figure out my sales price. 600,000 divided by my 20,000 gives me my sales price. And then what I do is I multiply that sales price by my 21,000, and I get sales of 630,000. Now I can look at my actual sales of 651. My actual sales, 651, budgeted sales, you subtract the two, I get a $21,000 difference, which is my variance. This is favorable because my actual sales are higher than my budgeted sales. I can do the same thing for my direct materials. Take my 200,000 divided by my 20,000, multiply that times 21,000, gives me 210. Then I pull in my direct materials right there, and I'll check it next time. Thanks.